Hello, good day everyone, and welcome to our first webinar of 2025. My name is Afrona, and I'm joined by my colleagues from the research team, Matthew and Bato. Today they will be presenting an overview of the drilling market and the expectations for 2025-2026. For those seeking detailed minute-by-minute insights, please feel free to contact us for a demonstration of our rig analytics platform, our comprehensive information source. As always, we encourage you to write down questions you might have during the webinar in the Q&A chat box. Our team will address them towards the end of this session. Additionally, the registration link for all attendees will be available on the following day. It is very important to remember that each of you has the option to take control of the slides and navigate them as needed if you encounter any connectivity issues. To do this, please use the arrows located at the bottom left side of this presentation. We hope you find the presentation informative and valuable. Matthew, the floor is yours.
Thank you very much, Afrona. Appreciate it. And thank you everybody for joining us today for our webinar, Navigating Near-Term Offshore Rig Market Dynamics. My name is Matthew Donovan. I'm Head of Rig Market Research at Esgian, and today I'll be joined by Bartolomej Tomic, our Senior Rig Analyst. Let's begin with our disclaimer. And our agenda for the presentation today. First, we'll cover the floating rig market, including demand in 2025 so far, upcoming supply changes, then a look ahead to 2026 and market dynamics beyond that. We'll cover the same for the jackup market, and then we have some regional outlooks, including in the US Gulf, West Africa, and Australia and Oceania. Beginning now with the floating rig market. 2025 has been off to a slow start for the floating rig market. Competitive utilization for floating rigs began declining in mid-2024, and as of mid-February of this year was at 70.8%, down from around 75% in mid-2024. We've seen lately, in addition to this slow demand, is multiple expected projects have been delayed, with drilling contractors struggling to secure new contracts for available rigs this year. Exacerbating the issue, multiple rigs this year are ending contracts earlier than expected, a combination of drilling efficiency, reduced work scope on projects, or disappointing early results in exploration campaigns. Now, for the floating rig market, the Golden Triangle does remain the focus of drillship activity, but some previously expected increases in West African demand have not yet taken effect, and demand in the US Gulf remains stable but flat. Recent fixtures by Petrobras have kept South America as the largest single market for drill ships. For harsh environment semi-submersibles, Norway has proved a solid market, but little activity is seen in the UK upcoming beyond some P&A work. What we're expecting is to see increased availability in the floating rig market over 2025, which could continue into 2026. Based on current data, there are currently 9 competitive drill ships that are warm or hot stacked and available with no work lined up for 2025. And a further 15 drill ships could potentially become available by the end of 2025. And this includes both 6th and 7th generation drill ships. For the semi-submersible market, current competitive units with no future work at this time total 13 units, with another 19 units potentially becoming available by the end of the year. Many of these are expected to secure contracts, but they could indeed be contracts for 2026 and beyond, leaving 2025 with extended periods of white space for much of the floating rig fleet. Turning to floating rig supply. Floating rig supply is likely to trend downwards, with some cold stacked units to be recycled, and more units indeed may be cold stacked. There are currently 109 drill ships and 92 semi-submersibles worldwide, including the cold stacked and under construction units. Our current cold stacked count is at 14 drill ships and 13 semi-submersibles. And if you turn to the charts on the right, on the charts on the right of the slide, you'll see floating rigs by time stacked, indicating the extended period of time that much of these units have been cold stacked. Now, in 2024 and previously in 2023, drilling contractors were beginning to reactivate units based on demand. What we've seen is that this has largely halted. And indeed, in recent months, Noble has announced plans to divest two of its cold stacked drill ships, the Pacific Sirocco and Pacific Meltem. We expect that further recycling of cold stacked units is likely, as many of the remaining units have been cold stacked for an extended period of time and are unlikely to be reactivated under current conditions. Reactivation of a long-term cold stacked drillship or semi-submersible could take well over a year and incur significant expenses, particularly if the SPS or other regulatory surveys are due. There's also the strong potential of future cold stacking for floating rigs that are unable to secure a new contract in 2025 or 2026. Drilling contractors have shown willingness in recent months to cold stack units rather than keep them warm stacked and competitive on the market. For floating rigs, there are few new units expected to be delivered over the next several years. Only two seventh-generation new-build drill ships remain. The Hanwha Ocean-owned Tidal Action is expected to be delivered this year, after which it will go to work in Brazil. There is a Keppel new build also that may need to find a buyer or bareboat charter before it is delivered. There are currently four sixth-generation harsh environment semi-submersibles that could be delivered over the next few years based on market demand, but potentially could remain undelivered if no contract is found for them. We consider new rig orders to be unlikely due to the high cost of ordering a new floating rig, which would require multi-year contracts at high day rates to be economical for the drilling contractor. Looking ahead to 2026 and beyond for the floating rig market, we are expecting demand to rise from 2025 to 2026. After the mentioned slow start to 2025, demand is expected to pick up more significantly for floating rigs in 2026. There are multiple long-term requirements for drill ships currently expected to begin in late 25 or 26, covering work in the US Gulf, Nigeria, Indonesia, Malaysia, and Suriname. Some of this will involve incumbent rigs securing work, but others will be available at this time and pick up new work in the coming years. However, campaigns may continue to be pushed forward, and some of the potential recovery in late 25 and 2026 could be postponed. There is uncertainty remaining in the market in the near term. We believe that excess demand will be partially absorbed by some of these requirements and other shorter-term work, while an expected reduction in rig count and increased cold stacking in 2025 will improve utilization in coming years. For day rates floating rigs, they are likely to remain flat over 2025 into the first half of 2026. Recently, we've seen leading edge day rates for seventh generation drill ships down to around the mid 400,000s, a little lower than the high 400,000s to low 500,000s achieved in 2024. And lower end of rates, particularly for sixth generation units, is in the low 300,000s. Day rates may likely see some improvement in late 2026 and beyond as demand solidifies. We are expecting operators in the market to retain high levels of capital discipline, which will constrain new exploration projects. However, most new developments are now sanctioned at relatively low break-even points and will remain profitable even if commodity prices decline. Looking forward, continued demand for fossil fuels, even if renewable energy usage increases, will necessitate continued exploration and development drilling for operators in order to replace their reserves. Move on now to a look at the jackup rig market. We've seen demand trending down in the jackup rig market, which remains affected by suspensions from Aramco. Jackup demand and utilization have continued to weaken into the first quarter of 2025. Along with the continued suspension of units by Aramco in Saudi Arabia, Mexican state oil company Pemex also began temporarily suspending jackups as a cost-cutting measure in late 2024. And the effect of these has seen competitive utilization begin to drop below 80% for the jackup market, although this will likely improve slightly as rigs potentially return to work in Mexico and the Middle East and some recently fixed contracts begin. The excess capacity of jackups from Saudi Arabia has only been partially absorbed by new contracts in Southeast Asia and West Africa, as Middle East contractors expand their global footprint and operators in other regions take advantage of the increased availability for jackups. However, we are seeing older or lower spec units from the Middle East continue to struggle securing new work in other markets due to their capabilities and a general operator preference for newer and higher spec units spreading. Taking a quick look at the current jackup demand, we see that national oil companies form the bulk of jackup demand, which can cause some specific issues within the jackup market. National oil companies make up around 64% of the current operators of jackups. Saudi Aramco remains the largest operator in terms of jackup demand, followed by CNOOC, ADNOC, ONGC, and Pemex. Now, there are benefits to this situation, including consistent demand from the long-term contracts that these operators tend to fix, and long-standing relationships with these operators and the drilling contractors. However, the risks of this concentration can be seen in recent situations with Saudi Aramco and Pemex. Demand can be affected by economic issues beyond simple commodity prices, such as payment issues with Pemex, or government decisions on projects in Saudi Arabia that have led to them reducing their current jackup demands due to the turning back of a planned increase in daily standard capacity. The preponderance of national oil companies as primary jackup operators is unlikely to change, as these state-owned companies control the majority of shallow water areas in the Middle East, China, India, and Mexico, which are the primary markets for jackups. Looking ahead to 2026, there are brighter times ahead for the jackup market. Despite the recent downturn, activity for jackups could stabilize. We could expect to see jackup demand remain relatively flat from 2025 through 2026. The previous upturn in the jackup market was driven by Saudi Arabia and other Saudi Aramco and other Middle Eastern operators. Without a future increase in activity from these operators, demand is not expected to rise significantly for jackups in the near term. However, in a positive sign for the market, we see new long-term tenders for jackups have been launched by ONGC, Qatar Energy, and KGO in recent months. Stability in the jackup market will also depend on how many jackups return to work with Saudi Aramco this year. We are now sort of closing in on the 12-month mark for some of the earliest Aramco suspensions, and drilling contractors are eagerly awaiting to see which rigs will be returned to work with Aramco. Pemex has begun resolving payment issues with some of its drilling contractors, which could also solidify demand in the region. Over the longer term, the NOCs that primarily use jackups are unlikely to turn away from oil and gas drilling completely, meaning there will be a market for shallow water rigs for many years to come. Jackup fleet rationalization can also be expected over the next several years, given a general shift towards newer and higher spec jackups, even in regions where standard jackups have traditionally worked. This could lead to improved utilization in the longer term as older jackups filter out of the fleet. Moving now to our regional outlooks. Looking at floating rigs in the US Gulf. The US remains a major market for drill ships, one where stable demand is expected over the next over 2025 and 2026. As I mentioned, the US forms one point of the Golden Triangle, with drill ships moving between the US Gulf, South America, and West Africa, which can affect regional supply in each region. Indeed, we will see one drill ship leave US waters for Mexico in 2027. Based on current long-term contracts and requirements under discussion, floating rig activity in the US Gulf is expected to remain stable over 2025 and 2026. We see regional demand for floating rigs is expected to remain around 19 to 22 units over the next 2 years. We have seen that super majors, including BP and Shell, are currently in the process of tendering for drill ships for multiple years of work in the region, which will replace some of the rigs currently under contract as their contracts expire. Short-term work is also important in the US Gulf. 1 to 3 well contracts or shorter well intervention and development campaigns are common with both majors and independents in the area and will contribute to demand. Floating rig demand in the US Gulf is centered around drill ships. There's currently only one semi-submersible working in the region. Jack activity in the region is expected to remain at low levels for the foreseeable future, with only a handful of remaining jackups, which generally are conducting development or P&A work on the shelf. Turning now to West Africa, where we are expecting to see floating rig demand in the region rise. Contracting for floating rigs in West Africa has been slow since late 2024, but several recent new fixtures and extensions in Ghana, Nigeria, and Namibia are expected to keep demand at around 11 to 12 units into late 2025. Floating rig demand is expected to rise from late 2025 into 2026 as a number of long-term contracts are fixed for work beginning in 2026 onwards, including tenders underway for several drill ships for multi-year terms offshore Nigeria. The slow pace of some projects in the region, capital discipline from major operators, funding issues for independent companies, and supply chain bottlenecks could result in some of this demand being pushed from 2026 to 2027 or beyond. Shell's recent decision to write down its recent exploration wells in Namibia has tempered expectations for the Orange Basin, but other operators are moving ahead with activity there. TotalEnergies may take FID on its Venus development in 2026, and the company is expected to begin drilling at a new prospect in late 2025, which could also lead into some exploration in South Africa. Galp will conclude its follow-up campaign at Mopane in the near future, and their decision on development will be eagerly awaited. Activity in Angola is expected to trend downward this year, but some contract extensions in the area are likely. There are also potential for shorter-term jobs in São Tomé and Príncipe, Côte d'Ivoire, Gabon, and other countries in West Africa in 2025 and 2026. Recently, Tullow Oil secured a rig for work in Ghana in 2025 and 26. But we've seen slow progress on multiple exploration prospects from smaller operators in the area. A rig share or sublet program may be needed for some of these wells to be completed. Turning now to the jackup market in West Africa, which has been a small but active area for jackups. A number of long-term fixtures have been fixed in West Africa over the past several months, including a 3-year contract in Nigeria, a 2-year contract in Nigeria, a 5-well contract in Gabon, 1-year contract in Nigeria, and a 2-year contract in Angola. And these recent contracts have brought in some jackups from other regions, including the US Gulf and the Middle East, absorbing some of the excess capacity from other markets. West Africa has proved an important area for jackups securing new work in recent months, but is not a major driver for activity on the same level as the Middle East. In addition to these recently fixed contracts, we are expecting some upcoming fixtures with Tower Resources in Cameroon for work in 2025, and there's potential work for jackups with Shell and TotalEnergies in Nigeria in 26. Several short-term requirements could result in work in Ghana, Angola, Congo, and Equatorial Guinea for jackups. However, the expensive drilling can result in work with smaller operators being delayed as they have to secure partners and funding first. Any new fixtures in West Africa for jackups will likely result in more rigs moving to West Africa from other regions. All right, and now I'll be turning to senior analyst Barto Tomic, who is going to be giving us an overview of the Australian rig market. Thank you very much for joining us, Barto.
Thank you very much for your introduction, Matthew. Slide 16, please. Everybody, thank you for joining. Now we shift attention to Australia and Oceania. Australia is the strongest offshore rig market in Oceania. Other countries include Timor-Leste, New Zealand, Papua New Guinea. Australia's offshore rig count hit its lowest point in mid-2023, with only 2 rigs active at one point and no spare capacity. Actually, there were 3 rigs in the country, but one contracted semi-submersible rig, Valaris MS-1, was placed on standby at the time due to legal issues. This has since been resolved, and the rig has been drilling for Santos at the Barossa development. The rig count rebounded in 2024 with 4 offshore rigs arriving in the country, 2 semi-submersible rigs and 2 jackups in the first half of 2024. 3 rigs arrived from the North Sea region. So 2 semis are the Transocean Endurance and the Transocean Equinox, and 1 jackup is Valaris 247. The other jackup arrived from New Zealand. Currently, Oceania has 7 offshore drilling rigs working, 2 jackups and 5 semi-submersibles, all in Australia. No drill ships are currently operating in Australia. The last one left in early 2020. It was working for Chevron at the time. As mentioned, no offshore rigs are active in other Oceania countries. 1 jackup could arrive in Australia in late 2025, 2026, and we expect to see 1 rig each in Papua New Guinea and Timor-Leste later this year. Currently, rigs in Australia are owned by Valaris, 4 units, Transocean, 2 units, and Noble, 1 unit. It's worth noting that Noble owns the Ocean Apex, which it acquired through the acquisition of Diamond Offshore. Current situation when it comes to the operators, Shell is soon be without rigs in Australia because it is working to complete work on its Crux development, where the company is using the Transocean Equinox rig. The rig will soon move to the other side of Australia, where it has secured contracts with a joint consortium of companies for multiple drilling programs. Slide 17, please. Australia rig utilization or supply might drop unless new contracts are secured in the near term. 4 rigs in Australia will complete contracts by August 2025. These are Valaris 247, the Ocean Apex, Valaris MS-1, and Valaris DPS-1. Depending on what the rig owners decide to do, either utilization or supply might drop unless new contracts are secured. 2 players are expected to start drilling in the region. Actually, they are planning to drill in the region in the first half using a jackup rig, which they don't have on a firm contract yet. So either a rig will need to be moved in from another region, or some current contracts could end earlier than planned or won't start at all. Valaris 247 is a candidate for both of these programs because it's on the right side of Australia for these 2 projects. Valaris 107 is not a potential candidate for this because it's on a longer term contract, including options, and only becomes available in Q4 2026. But there are potential clients on the southeast coast for it after the contract ends, so it's not likely it would move to the west side of Australia. Bringing in new rigs to Australia can be a lengthy and expensive process due to mobilization costs that are high and NOPSEMA's safety case requirements. Additionally, there have been talks of a jackup rig from Asia potentially arriving in the region in late 2025 or early 2026. When it comes to the utilization percentages in Australia, these have been high because if a rig has moved to Australia, it's there to drill, not to be stacked. Slide 18, please. When it comes to exploration in Australia, offshore exploration drilling in Australia hit record lows in 2024, with no oil and gas wells spotted. So no oil and gas exploration wells spotted. Development drilling has happened. A government report highlighted the need for increased gas exploration as supply shortages loom for both east and the west coast. A report has found that offshore permit approval times increased from 150 days in 2015 to over 375 days in 2022. Mid-2024 saw exploration permits awarded to Chevron, Impex, Melbana, Woodside, Exxon, and Beach Energy, which could boost future rig demand. But this is not in the near term. For example, Melbana's license calls for it to, should it elect to do so, calls for it to drill in the 6th year, which would mean that a rig will be required in September 2029 at the earliest for Melbana for this drilling. Still, exploration drilling is set to resume this year and the next one, with exploration wells planned by Chevron, ConocoPhillips, Beach Energy, Amplitude Energy, but only using contracted rigs. So this is not a demand for new rigs to come. Chevron will use the Ocean Apex, while all the other ones are expected to use the Transocean Equinox for their exploration drilling. Recently, two companies have signed letters of intent to use a new build jackup that could arrive in the country in late 2025 or early 2026. Separately, Coastal Energy is negotiating a jackup for late 2025, and it said this is likely to arrive from Asia. It remains unclear if this is the same new build rig that first two companies have signed the LOIs for. We've also seen that Santos's Dorado project FID delayed, which is possibly pushing back jackup demand. Chevron will need a floater in the second half of 2026 for 7 Gorgon development wells. Santos may require a semi-sub in late 2026. Inpex will need a floater in 2027 for its Ichthys Phase 2 drilling. In Papua New Guinea, TotalEnergies expects to use a floating drilling rig to drill the Mailu prospect later this year. And also Twinza is planning development drilling at one of its projects with a jackup around 2027. In Timor-Leste, Sunda is looking to drill an appraisal well using a jackup rig. In the country, 2 wells are also possible in 2026, also by Sunda and by ENI. In New Zealand, there are no immediate offshore drilling plans. Government said last year it would rescind the previous offshore drilling ban imposed by the previous government and work to encourage further offshore drilling to boost the country's energy security. Now, looking ahead, near-term demand for new rigs in the region is expected to ease with a focus on shorter programs. The situation should improve from 2026. The lack of near-term demand, however, in Australia could lead to rigs relocating, tightening supply, and increasing future drilling expenses, particularly for smaller operators, which could also lead to drilling project delays for these smaller operators. Thank you for your attention. Afron and Matthew, back to you.
Thank you, Matthew. Thank you, Barto.
Yep, thank you very much, Barto, and thank you all of us for joining us at our presentation today. We have our contact information here if you'd like to get in touch for more information. We also have time for some questions at the end here, which you can submit through the Q&A. If we don't get to your question during this, we will reach out after the presentation.
Yeah, so team, we might need your attention again as few questions have already come in. So I will start by reading the first one. One is directed to Matthew. How do you see 2027 in comparison to 2025 and 2026 for floaters and jackups?
I would say for jackups, it is more of a kind of a flat trend from 26 into 2027. As again, we're seeing a lot of units on long-term contracts, seeing some sort of sustained demand rather than rising demand in those areas. So I think it will be rather a flat trend for jackups going forward. Turning to drill ships and semi-submersibles, so for floating rigs combined, as you mentioned, we do see a little bit of an uptick coming in from 25 into 2026, and I think usually probably what we'd see is more of a flatter trend from 26 into 2027 after that. So rig demand stabilizing at similar levels seen in 26 into 27.
Thank you, Matthew. Another question is, Chevron and other operators are currently announcing downsizing of their staff. Do you estimate that this cost-cutting will carry over to drilling programs? Operators will need to replace their reserves and require exploration in long term.
Yeah, as the question itself points out, there will be a certain amount of drilling that will have to take place, and there's obviously projects that have already been sanctioned, rigs that are already under contract. Operators have been, as I said, really since the previous downturn, operators have been very consistent in terms of capital discipline. So I don't think we'd see any change in that going forward. People are going to be looking very carefully at their budgets year to year and region to region.
Thank you, Matt. I will take one more question maybe for Australia. Can you tell us more about the new build jackup rig that could come to Australia and the LOI signed?
Yeah, it's worth noting that nothing is set in stone with this one because, for example, Gulf Energy and IPB Petroleum have signed a non-binding letter of intent with a US-based Titan Drilling for the use of TS Jasper jackup rig. This is a rig that should have been delivered in 2017 to the previous owner, but the order was cancelled eventually, and it's still in the shipyards in Singapore. IPB plans to use the rig in late 2025 or 2026, depending on when the rig or whether the rig arrives in the country. They will drill an exploration well in the Browse Basin. As for Gulf Energy, they plan to use the rig to drill their Lion prospect in the Bamaga Basin in mid-2026. As for the potential rig owner, it's the name of the company is Titan. It is a subsidiary of Greenbound Group based in Texas, and who is in the process of funding the purchase of the TS Jasper. The plan is to use it to develop a series of small fields off the northwest coast of Australia. So the rig is currently in Singapore and is expected to be delivered by the end of 2025. It will be offered to the Australian market for approximately 1 year for drilling services before deploying it to the northwest coast to work as mobile offshore drilling and production unit. TS Jasper is a KFL's N+ design. It's one of the largest designs of jackup drilling rigs available.
Thank you, Bato. We appreciate all the questions you have submitted. Due to the time limitations, we'll make sure to reach out to you individually to address any we couldn't cover today. Thank you all for joining us. If you have any comments, feedback, or questions about the presentations, please don't hesitate to reach us out. Have a wonderful day ahead, and until next time, take care and be well.
Thank you very much.
Thank you.
Thank you.
Bye.